All right, the last section in this chapter talking about the Great Recession of 2008. It's interesting actually talking about this now because I think what you'll see um, living in 2020 in the middle of a pandemic is a lot of what we're going to see economically actually kind of starts to parallel some events before and after the recession. So this may be maybe somewhat of a tough topic because we're living through it, but at the same time, I think it's important to see um, kind of history repeating itself in action. So we should start first by talking about what the housing market is, right? This kind of sits at the center um, to the recession in 2008. So the housing market isn't necessarily like Zillow, right, where I go online and like actually look for a house. We're talking about kind of like the general abstract market, kind of talking about this general market of houses, um, meaning the buying and selling of houses. So those being purchased and sold between buyers and sellers, right? Either directly by owners or indirectly through brokers. So we're just kind of talking about, are people buying houses? Are people selling houses? And we're able to quantify that, right? We're able to come with some sort of a quantitative measure for that. It's just the numerical measure for that, called the Housing Market Index, the HMI. And this is an abbreviation you're going to see throughout this PowerPoint. That's a figure, it's just a number based on a monthly survey of members of the National Association of, this should say, home builders or housing builders. I think it's either housing or home, I can't remember which, but there's an H in there because the abbreviation that we use is NAHB in order to gauge the single family housing market. So this is important here. This metric is for single family houses. So maybe a little bit biased in a lot of ways. Basically what this housing market index is saying, and what the market is saying as a whole, I'll move it down here, is to say how conducive is the environment, or is the country, I guess I would say, to those trying to buy or sell a house. Trying to buy or sell a house. Right? What are the conditions right now? And if I want to go to look for buying a house, how easy is it for me to do that? Well, this housing market has a whole list of influences, right? This could be based on, the housing market is based on kind of the rating of the market conditions, right? So if you've ever heard that there's maybe a boom in the housing market or there's some sort of a crash in the housing market, right? That's obviously going to positively or negatively impact the housing market. Current conditions, predictions over 6 months. So, where are we now? Do I expect the market to rise or fall based on what I'm seeing? So we're talking about using data to make predictions, make trends. And this ranges from 0 to 100. And we call this a diffusion index. So called because anything above 50 indicates a favorable outlook on the market, right? So I want something that's a 50 or better. So we'll kind of you'll see this housing market index throughout this PowerPoint. So always really keep in mind, right? Anything above 50 is favorable. Obviously, anything below 50 is very obviously unfavorable. So some things to keep in mind from the get-go. So the NAHB publishes their reports every month, right? So this is actually taken from the April 2020 NAHB report. And they're not wordy. They're very specific. They're very concise and detailed. They point to specific factors that impact the NAHB's decision to come up with a certain number for the housing market at any given time. So this is actually taken right from the the report from a couple weeks ago, right, from April 15th. So, and it says, reflecting the growing markets, the growing effects of the COVID-19 pandemic, builder confidence in the market for newly built single-family homes plunged 42 points in April to 30. And right in that first sentence alone, right, they identify the kind of the key players, right? COVID-19 is playing a huge role in people being willing to buy and sell houses. As a result, we've had a huge drop in kind of our confidence in buying houses, right? This 30 kind of indicates low confidence in the housing market. As social distancing and other mitigation efforts show signs of easing this health crisis, we expect that housing will play its traditional role in helping to lead the economy out of a recession later in 2020. So even though we saw this huge dip in the housing market, we see that the NAHB is actually pretty optimistic, right? That housing will actually help us out of a potential recession, right? So the NAHB actually is, fairly hopeful. And these are the kinds of reports they put out every year, and this really influences our perception of the housing market, right? Is this an environment that is conducive to buying or selling property? So that's all kind of your setup. The other main thing that we need to talk about, right, is what a recession even is in the first place. Anytime I'm talking about kind of lowercase r recession, it's just any sort of general decline or stagnation economically. Because of the recession, this definition has become more specific, and it's targeted specific sectors of the economy. These have included things like our gross domestic product, industrial production, trade, oil, unemployment. So here are some more of those factors. But it's a much more specific definition, right? We're looking at specific key areas as benchmarks for economic stagnation. And this, obviously, we need some kind of a trend, right? Just one quarter of dip in our economic growth is not enough. We need to see at least 2 consecutive quarters of this stagnation or decline, right? We actually need to see a trend potentially forming. Right? One point of data is never enough. You need to see a few. So because of this, we've actually been able to backdate what we used to call, or what we do call, the 2008 recession. But if you go back and trace where this economic stagnation really began, we're actually going to start all the way back in December of the year before, December of 2007. So at the core of the recession is what we call the subprime mortgage crisis, the subprime mortgages. What these are, and we'll kind of talk about why these are important in a minute, but these subprime mortgages are home loans, right? So they're mortgages granted to borrowers with poor credit histories. If you remember from one of the projects we did, we had you had excellent credit, you had prime credit, you had subprime credit, right? Those poor credit histories is where we get that term subprime from. And this is linked in part to this housing boom in the early 2000s. There's a lot of economic activity. So much so, right, that if you actually head over here to our housing index, you see a rating of 72, which is really good, right? Well above that mark of 50. One of the highest numbers that you tend to see. So there's a housing boom in the early 2000s, right? There's a lot of comfort with the housing market. And as a result, lenders were less restrictive about the types of borrowers they approved for credit. This is risky. This is extremely risky. Subprime mortgages are high risk. And if you're asking yourself why, right, you can think back to our unit on loans. It is high risk because poor credit generally means you're not very responsible paying back your loans, right? So I'll say that, right? Poor credit usually means maybe somewhat financially, I'll use irresponsible for lack of a better word, but that's not really where I'm going here. But you might have some trouble taking out too much debt, more debt than you can afford. Um, these are extremely risky, but housing prices are rising, right? If you think about supply and demand. Um, so if prices are rising and lenders are less restrictive about the types of borrowers they approved, um, you saw lenders getting greedy, plain and simple, right? More borrowers means more money. Why? Because there's more interest being paid, right? There's a whole, supply and demand here. So this is kind of the precursor, right? The start of everything that we're talking about. We move on to April of 2007. Two events begin to happen in tandem, right? Two big things start to happen. You start to see our housing market dip, and that's actually not one of them, but you start to see the housing market plummet, very much like ours did just recently. But you see two big things. One is that New Century Financial goes bankrupt. This is a large mortgage lender. So let me write that. This is a large mortgage lender. And they go bankrupt. That's huge. The other one is that the Federal Home Loan Mortgage Corporation, which is better known as Freddie Mac, um, announces that it will no longer purchase subprime mortgages from its lenders. So until now, up to this point, and this is something that still does happen sometimes, but previously lenders could sell mortgages to larger corporations for security, right? So lenders would take their loans, would sell their mortgages to larger corporations such as Freddie Mac, to larger corporations for their own security, right? They want to protect their business too, right? They don't want to take on a high risk loan if they themselves don't have the security to back it up, the insurance to back it up. And this got to the point, this subprime mortgage approval got to the point where even Freddie Mac said, no way, right? I am not going to continue to approve these loans and buy these loans because it's becoming too risky even for our big company. So as a result, because there's no market for these subprime mortgages, there's no way to back your investment if the mortgage were to go under, if the um, if the lender were to default. So as a result, New Century Financial collapses. This is kind of the first red flag, I guess, so to speak. This is really the first big event. So we're starting to see a little bit of a collapse, a little bit of a panic, and that's indicated by our HMI dropping even farther. Um, we see now the second giant to fall, right? This is kind of our second lending giant. They will eventually fall because they file for Chapter 11 bankruptcy. Um, and you see this quote actually right from NBC and the Associated Press about everything here, right? About what's going on, saying that even AHM falls victim to what they call extraordinary disruptions. And it cuts off the funding they need to make new loans, and that is to buy new loans, right? They can't take on these loans. You see home prices start to dip. You see a spike in payment defaults, and as a result, that scares people away from taking on this mortgage debt. So kind of to summarize that, right? You have decrease in housing prices. You have a rising rate in defaulting on your mortgages, which of course also means foreclosures. And as a result, right, this kind of creates the perfect storm that investors start to get worried about their investments, about losing money on their investments. And obviously, it's not something that they want to do. And this is where you start to see the foundation start to crumble. So then we move into the housing market crash. So all of these things kind of hit at the same time, or over a period of not a long time. And you start to see the housing market fall with these lending corporations as well. Of course, declining market ratings means declining housing prices because there's a lack of confidence, right? I'm no longer confident that my purchasing, um, that my house is priced at a point that I can afford it. I'm no longer confident that I will get approved for this loan. I'm no longer confident that if I get approved for a loan, then what if I default on it, right? What if I'm getting screwed? And that's what I'm afraid of. If we actually think back to the beginning of the year, this represents a shift in the demand curve, right? If we, not here, curve, if I were to think about way back to the beginning of the year about my supply and demand, right? Here's my supply and here's my demand. Here's my supply curve, right? And maybe here's my demand curve, right? Here's kind of the demand for my houses. Well, this isn't something that price is gonna impact, right? This is an external issue that's causing my demand curve to slide back. We're seeing a dip in demand. You see that equilibrium point is much lower than it might have been originally, and that's causing a lot of concern. So of course, as a result, because of this shift, that means you still want to get near your equilibrium point, so you see the price drop, which is exactly what you're seeing here, right? The market value for existing homes declined sharply in this period. But there's a huge supply. So you're seeing this saturated market, right? There are a ton of new homes being built. So you see high supply, low demand. You have a surplus, right? You have an extreme surplus. And what ultimately happens is that the home value is less than the principal of the mortgage. This is obviously not good, right? If we think about equity, right? If you have, say, maybe your house is worth $200,000 and you've paid it down to a principal of, I don't know, let's say $100,000, right? You have some equity in that, right? That gives you something extra to work with. Well, what's happening here is that maybe if my house is now valued at $200,000, I want to keep the same color. But maybe when I had taken out the mortgage, I had to take out a $300,000 principal, and this is what's causing trouble. Technically, it means my equity is negative, right? I owe $100,000 more than the house is worth. That's not good. So we call this being underwater on your investment, right? You're paying more than the house is worth. This is a huge, huge, huge issue. As a result of this lack of confidence in the housing market, the stock market starts to fall too, because these are all types of investments. So just like buying a house, obviously you put money into a stock hoping to, sell when it's high and buy when it's low. So all of these are interconnected. So in 2007, in October of 2007, the Dow Jones reaches an all-time high, breaks 14,000 points. Obviously now 13 years later, we've seen it go higher than that, but for the time being, this is an all-time high. This is a huge record. I'm going to post the link to these slides so that you're able to check out links like this. And choose a better color than that. So you can check out these links if you want to. I highly recommend it. This is a CNN report from the day, or right around when we were starting to peak. I couldn't get the exact date. It's from a year later. But what happens though over the next 18 months, and this is actually why I chose the report from this day, is that you see the Dow Jones go from this 14,000, this all-time high, to losing almost half of its value in just 18 months. That's not a lot of time in the scope of the stock market. As a result, if you see this market plummet, you lose money on your investment. So what happens is that a lot of people had invested a lot of money and a lot of their life savings because they saw this boom in the stock market. As a result, these investments lost a ton of money. People went broke, people went bankrupt, just because of how much and how recklessly they were investing in the stock market. So this report is kind of meant to talk about that, and I highly recommend you check it out. Kind of living history, so to speak.